Hey everyone, it's PK here. Hope you're doing really well. If you're watching this on Facebook, then if you like or are interested in anything I say, just press like or comment below, and that way the Facebook algorithm, it will just give you more of my videos, which may be a bad thing or maybe a good thing depending on whether you like them or not. And if you watch this on YouTube, just subscribe so you can continue to get a lot of this value. So today I'm going to be talking about tax. So I think the majority of investors still, to this day, invest in property for this reason of saving tax. Okay, it's like this well ingrained thing in our society that if you are on a high income, if your household income is above 150k per annum, then all of a sudden, you need to reduce tax. And the way that you do that is through investing in property. And obviously the way that works is through negative gearing. But in this video, I'm going to be talking about how, yes, you can achieve that outcome, but at the same time, develop a passive income. So it seems a bit counterintuitive, but let me explain that. So the way that negative gearing works is that if your expenses are more than your income, right? So if all your expenses in holding a property is above your income, your rental income, then that property is making you a loss. So let's say the property is making you a loss of $15,000. So that $15,000 would be deducted against your income. So let's say you're making $150,000. Now, all of a sudden, for tax purposes, you're making $135,000. Now, of course, what that means is that you're paying less tax based on $15,000. So at a 30% tax rate, which you're obviously on higher than if you're on 150k, you're saving $5,000 in tax. So I would say that there is at least 1 million investors in Australia who invest in property for the exclusive purpose of negatively gearing their property and saving in tax. And that makes for a great marketing strategy for house and land packages, for off-the-plan apartments, because of course, those types of properties are negatively geared. So an investor is happy, the developer or marketeer, sometimes a buyer's agent, is happy, but really the property investor is not going to be happy in the long term because that property doesn't go up in value as much as it ought to if it's an off-the-plan apartment or a house and land package in fringe areas of a city. Okay, so that's the tax side of things. So earlier in this video I said, well, you can achieve the tax purposes, you can get your offsets, but at the same time start to make passive income. So there's no need to choose. Sometimes people are like, no, property is good for tax, and if it goes up, then that's a bonus. That's only a bonus, and I don't really need it to go up, but as long as I'm saving tax, that's my primary reason for investing. Now, that's one school of thought. And the other school of thought says, no, we never invest for saving tax. We should always invest for capital growth. We should always invest for passive income. Passive income in the property context simply means positive cash flow, where your expenses are less than your rental income. Therefore, you pocket $3,000, $5,000, $10,000 per annum from a property, hypothetically. So there's two schools of thought, right? Now, what I want to describe for you and to you today is that actually you can have the best of both worlds. Why on earth would you invest just to save tax when you can get the passive income, when you can get the short-term and long-term capital growth as well? That doesn't need to be just a bonus. That's something that you should be targeting concurrently, simultaneously at the same time, right? So bear with me. So the way to do that is, and basically all of my properties are like this, all of my buy and hold, just passive properties are like this. We want to be buying properties that before tax are positive cash flow. I've got a bit of a hair sticking out, sorry. Before tax are positive cash flow. What that means is that before taking into consideration things like depreciation, your income, your rental income, is a lot more than your expenses. Okay, so your rental income is a lot more than your expenses. And what that means is that you're generating passive income. That's a positive cash flow property. All right, so let's say the rental income is 20,000 a year, round numbers, and your expenses are 15,000 a year, round numbers, right? That's giving you $5,000 in your pocket every single year. But the way that negative gearing works is that it accounts for not just cash expenses like interest payments, council rates, maintenance costs, property management fees, insurance. It doesn't just count for cash expenses, it also accounts for non-cash expenses. So what's a non-cash expense? It's like depreciation. So every single year a house will depreciate in value, and in Australia you can see that as an expense. So let's say you have a house. I personally have a house that's about 7 years old, one of them in my portfolio, and that gives me depreciation of, let's call it $10,000 per year. Now, obviously on a diminishing depreciation schedule that will diminish over time, but just for now, let's say it gives me $10,000 every year. So what that means is I have generated a positive cash flow before depreciation, before tax purposes, of 10,000 positive, right? That's what we just said. Did I say 10,000? No, I think I said 5,000. So $5,000 positive cash flow before depreciation. But then I have this non-cash expense. So I'm actually having to pay anyone, but it's still an expense of depreciation of $10,000. What that means is that 5,000 positive cash flow has now all of a sudden become negative 5,000, right? Positive 5,000 minus 10,000 equals negative 5,000. So now I'm going to be declaring that I've actually made a loss on this property of $5,000 per annum. And depending on my marginal tax bracket, and just for round number purposes, let's just go with 50%, I would get $2,500 back from the taxman every single year. So I've reduced my taxable income by $5,000. My marginal tax rate, let's say, is 50%. I get half of that back, $2,500, which gets added on as a tax refund, added on to the pre-tax positive cash flow that I generated, which is $5,000, remember? So this property is giving me $5,000 positive cash flow before tax and $7,500 after tax. I've made the most of tax deductions, and simultaneously it's a positive cash flow property that is paying me a passive income from the very first day that I got it. And of course these are just round numbers. You can buy a positive cash flow property for $2,000 that has $15,000 of depreciation, and that would save you more tax, still achieving both of those concurrent goals, right? Now here's the kicker. If you're aiming to buy these sorts of properties, established properties, not super old, but established properties that give you tax deductions and that are positive cash flow, you don't have to buy off-the-plan apartments. You don't have to buy house and land packages in the fringe suburbs. You can actually optimize the suburbs that you want to buy. And what that allows us to do is to scan the 15,000 suburbs across Australia and pick the ones that, the one or two, let's say, that'll actually grow in the short term, right? Every suburb in Australia has its day in the sun, so to speak. Every suburb will at some point boom, as the spruikers put it, and every suburb will also plateau. What we want to do as sophisticated property investors is not just get the tax benefit, not just get the passive income, but simultaneously pick the suburb that is going to boom very in the near future. And I don't want to use the word boom, let's just say increase in value significantly. All right, every suburb will do that over the course of 10, 15, 20 years, but we want to buy using data, using science, the one that is going to go up next, or the one that's going to go up very, very soon. Now, you can't predict that down to the day, down to the dollar, but using data, you can definitely be much more prescriptive, much more exact than simply saying I want to be buying close to a shopping center or close to a park or close to the ocean or close to the CBD or, you know, where there's good schools. All that stuff is fine for the long term, but we want to be using data to be finding a suburb that will grow in the short term, not just the long term. And the way that compounding growth works is that any subsequent growth will then have a higher base off which to grow. Okay, so I'm kind of going on a tangent there, but the main point of this video was the fact that you don't just go for a tax minimization strategy. Yes, if you're a high income earner, tax deductions matter, but simultaneously think about passive income. It's possible to have both and capital growth. That trio strategy that I just made up, call it a triangle strategy or whatever, that is what will get you to your long-term goals. If you simply want to reduce your tax, what you're saying is that I want to make a loss so that I can reduce tax, because that's the only way you can reduce tax, is to make a loss, right? That's just how tax rules work. But through property investing, which is very unique to Australia, negative gearing, you can get the tax benefit, you can get the passive income, and you can have some flexibility to choose the right suburb to get capital growth. And in that way, by being a little bit more educated, thinking outside your comfort zone, thinking outside the box, so to speak, you can actually set yourself up, probably not in 5 years, maybe not even in 10 years, but in 10 to 15, maybe 20 years, to actually generate a 6-figure passive income from property, which is what countless people have done, but you have to do it the right way. So hopefully that makes a ton of sense. Like I said, if it does, just please let me know. And if you have any questions, just comment below. If you're watching this on YouTube, just subscribe, or on Facebook, at least just like it. And then how the Facebook algorithm works is that you'll get more of my videos. If you don't want my videos, don't like it, because then you'll be spammed by them. All right, guys, my name's PK, and I'll put a link down below where you can learn more as well. Catch you later. Bye.